So there definitely is a gap between where interest rates are in Canada and the US. And I've been getting a few calls and questions. How far can they diverge? How can they be more than, let's say, 1 full percentage point difference between the Bank of Canada rate and the federal funds rate, the Fed funds rate in the US? They're about that right now, maybe 75 basis points in that range. If we cut rates at our next meeting and the Fed does not cut rates, well, there you'll have it. It'll be a full point difference between the two. And what does that do for our economy? What does it do for our dollar? What does it do for inflation? My opinion, our dollar will continue to weaken. And you couple that with the potential tariffs being levied by the U.S. on Canadian goods, and our dollar could weaken even further. We actually saw it go below 71 cents recently, and it has peaked back up above 71 cents today, 71.3 cents last I checked. But the other day it was below 71 cents for the first time in a long time. Could we see a 69-cent dollar if we continue to cut rates and if the U.S. were to place tariffs on all goods coming from Canada? I think it is quite possible. First chart we have here shows that Canada's annual inflation rises back to 2%. And you can see it here. It shows here that our interest rate now, 3.75%. That is the Bank of Canada rate. You see there, the CPI at 2%. And overall, still tells us we have some cushion there to cut rates. Once upon a time, the inflation rate was double, or the Bank of Canada rate, I should say, was double the inflation rate. That is no longer the case. If we cut a quarter point, I think 50 basis points is probably off the table now. But if we cut a quarter point to 3.5%, you're starting to look now at 1.5% difference. Perhaps we cut a couple more times early next year, and that gap or cushion between the two starts to dwindle. And as I said, if we are aggressive, if the Bank of Canada is aggressive and the U.S. Fed is not, we could see ramifications, or we could see things play out in the currency market, in the inflation situation, and in the investment market, in my opinion, as well. Our next chart here shows the Fed funds target rate. And you can see here, it is a range of 4.5 to 4.75. So individuals will say that their rate is somewhere around 4.625%, well above our rate. And we say, well, what does this mean? Well, look what it's doing to our currency. That is our next chart. Look how much our currency has deteriorated. Canada versus US, spot exchange. Look at that slope down. It is probably the opposite of what we'd like to see. We'd like to see our dollar somewhere around 74, 75 cents. That is probably the average. If you go back over time, probably see an average between 73 and 75 cents. We have not seen it in that above 75 cents in quite a while. And the difference in interest rates and now plus the tariff conversation is definitely affecting our exchange rate, which is not good, especially if you want to take a trip to the U.S., especially if you are importing goods from the United States. That hits you the hardest. It increases the cost of goods that you bring in to build your products to sell here in Canada, and eventually, if those products and pieces that you bring in to build, if that is increased significantly, that will reflect on the bottom line pricing, and therefore we will see more inflation here in Canada. A great chart that we have, and it's one of my favorite charts for the week or for the show, and that is the rate divergence. And you can see here when the rate divergence was at more than a full percentage point. You see in the mid-90s, 97-ish, we saw a big divergence between the Fed funds rate and the Bank of Canada rate. You also saw that around 2000, 2001, also 2006-07 timeframe. And we really haven't seen a little big divergence since then. And now we're starting to see a little bit of a divergence. As you can see, the forecast going forward into 2025 is a bit of a divergence. Fed funds rate looks to be higher, and Bank of Canada looks to be a little bit more aggressive in cutting rates. So overall, we got to definitely keep an eye on the gap in interest rate policy between the Bank of Canada and the Federal Reserve. I think the Bank of Canada is definitely keeping an eye on it, and it's something that I know importers are keeping an eye on, and investors should keep an eye on as well.